What's up, guys? Welcome back to the channel. In today's lesson, I'm going to teach you a high probability liquidity sweep strategy. This is actually a VIP content, but I have to share it to the YouTube community. So if you're struggling to succeed in the financial market, you can focus on this particular trading strategy to make good money for yourself in the financial markets. You know, I teach about smart money concepts and I talk about how the institutions trade in the financial market. So this is another valuable content that is going to help you become better in the financial markets. So this is titled a high probability liquidity strategy. So if you are interested in concepts like this, consider subscribing to the channel. I'm Solomon Wisdom, and here is Born to Trade. Let's jump straight into what we have for today. Now, when we talk about liquidity in the market, you already know that everything in the financial market revolves around liquidity. Liquidity is what moves the market. Now, liquidity sweep is a strategy used by smart money traders. Smart money begins by placing a large hidden order on the opposite side of the market direction. In this particular area, let's assume that smart money wants to buy. What are they going to do? Price is going to push aggressively to the opposite direction, sweeping liquidity at the low of this particular area. Not just sweeping this liquidity, but is going to put traders at the wrong side of the market, especially breakout traders, even support and resistance traders as well, who sees here as a resistance level, looking to buy once price hits this particular level and continue to the upside. Yes, their bias in the market is correct, but the breakout traders as well, in this case, they're looking to maybe trade the break and the retest then to the downside. But in this case, smart money is going to place large sell order in the market, which is going to push price aggressively to this low, take the liquidity, then pushing price to the opposite direction, allowing smart money traders to fill their order at a better price. Let me explain this with a 3-step that will help you make good profits and spot it easily in the financial market. Okay, now I'm going to give you 3 steps which you're going to use to identify this particular price action, take advantage of it, and make money from the financial market. So looking from the sketch we have at this particular area, price forms this low. You see a high was formed at this area, a pullback, and price continues to the upside, which breaks structure. And this is a very good break of structure. Now, some institutional traders as well is going to be looking to trade from this particular area, more like smart money traders. They're going to look to trade from here. Now, support and resistance traders who sees here as their support level, looking to buy once price comes to this place. Now, we have different people looking at this particular area. Firstly, we have traders who are seen here as their resistance level. Secondly, we have smart money traders looking to buy from this demand level right here, because definitely we're going to have a demand level at this point. Now, what is smart money doing? They are building liquidity. A lot of orders are resting at this particular area. A lot of money is resting at this particular point in the markets. A lot of money. Now, what they're going to do is, since they have the intention of buying, yes, they want to buy in this case. And you see, every other person that is looking at this market has the same bias. Smart money traders who are looking to buy from the demand zone, they know that price is going to push to the upside. Those who trade retail-based strategy, that's looking at here as their support level as well, they're going to be looking to buy to the upside. Now, smart money don't want you to trade with them in this case. What are they going to do? They're going to enter large sell order in the market, which is going to push price to the downside, make sure that the liquidity at the low has been taken. So this is where I bring the concept of high probability liquidity trading strategy. Now, I want you to take note of the first step. The first step has to be the liquidity sweep, okay? So you have to note right now what we want to identify in the market is liquidity sweep, but have it in mind that you need to understand the general idea of the market. Currently, price is bullish. The order flow in this particular area, price is currently bullish. Price is pushing to the upside. So at this point, price sweeping liquidity on the net, the low, has to give you the idea, okay, price is bullish. Now we have to pay attention to what price is going to do. Now, the first step is right here, where you identify your liquidity sweep, because the order flow is bullish. Now, price sweeps the liquidity at the low. Now, since price takes the liquidity at the low, you understand that price is going to push to the upside. Now, you need some other confluence. What's the confluence do you need? You need a break of structure or a market structure shift. That is price breaking structure. And that break of structure has to come when price reacts with good candles. That is candles with large body, even if it's not really a full big candle with large body, but the candle need to have pricing efficiency. So at this point, after the liquidity sweep, price moves with momentum, breaks structure above the high. The second step, which has to be a break of market structure, or you identify where price shifts in structure. After you must have identified this, because you can clearly see, if you try to read maybe the internal structure, you can clearly see that the internal structure was bearish. Internal structure was bearish. Price breaking structures to the downside. But at this point, we have the market structure shift, which indicates that price is going to be shifting in structure, and we're going to be expecting higher price at this particular area. Now, when you identify this market structure shift, what you have to do is to select your POY. Okay, you have to select your POY at this particular area. Now, at this point, since you're looking to buy, what you're going to be selecting is your demand level. So this is your point of interest right here. Once you select here, this is where you place your order, waiting for price to come back to this particular area at your point of interest. And you're going to look to buy from this particular area and you place your targets. Now, I advise students to place their target. Firstly, you can do it based on having a specific risk to reward ratio, which is favorable to you. And secondly, you can look to target to external range liquidity, but have it in mind that price will not always get to the external range liquidity. So we're going to use the same steps from here. We're going to use the same step for this particular sketch right here. And you have to understand that this is just the same thing. It's just trying to understand this better and understand what price is actually doing in the market. Now, firstly, we're going to see have a break of the high, price is bullish. So forget about the drawings, just like I explained. It's just the same price action, just identify where price takes that liquidity. Now we have a break of structure. Before price was able to break this high right here, what can we see during the pullback? During this pullback to the downside, we're going to see that at this point price slowed down a little. And when price builds liquidity in the market, this is the most obvious one where we see price slowing down a little in the market. Here we have this slowdown right here. Now, any trader that is looking at price at this particular area, liquidity is resting at this particular low. Now, price sweeps that liquidity, not just sweeping the liquidity. When the liquidity was swept, price mitigates a demand level at this particular area. So, liquidity sweep and a mitigation. Now, price reacts massively to the upside. Now, in this case, what you can clearly see right here is that price breaks internal structure, which gives us a market structure shift on the lower time frame, and we look to get involved in this lower time frame demand. But in this particular case, when price builds this liquidity, sweeps the liquidity, mitigates this demand level, you clearly see that price reacts massively to take the external range liquidity that is breaking above this particular high. Now, we're going to expect a pullback as always. Now, you have to do this using the rules. Firstly, you see price sweeps liquidity. Secondly, price reacts massively to the upside, and it was able to break structure. And the third step, you have your demand level, which is your points of interest. In this case, price returns back correctively, mitigates your level, and you have good reaction to the upside. So this is the whole idea right now. I don't want to start taking a lot of time explaining this. Let's just look at the examples. It's going to help you understand better. And you have to understand when you talk about liquidity sweep strategy, a lot of people might teach it in different ways, but what I'm teaching is what I trade. What I love about this particular trading system is that I'm able to impact it into some of my students, and they're actually doing well trading with this particular pattern. So let me show you examples, and the examples I'm actually going to show has to be results from some of my students. So let me show you some of the examples we're going to look at right now. So these are VIP community. These are VIP community right now. Now, this is actually one of my students. He's doing very well. So this is one of the examples which we're going to use. This is on AUDJPY, and this is another one. This is on NZDJPY. I want to look at that. And I think some other people shared some good results using this particular concept. So let me see. And this is another good one. This is on gold. So I will try as much as I can to use these examples to convey this idea so you will understand better. Okay, this is what I'm going to do in today's lesson. So let's start with the first one, which is the AUDJPY setup. Let's do that quickly. He cut that trade on the 30 minutes time frame. So when I saw him share that particular results, I was impressed with what I was seeing in that particular trade which he cut. That's why I shared this particular results to my platform. So if you look at this particular area, looking at what price is currently doing, what is price doing? The order flow is bullish. Price is pushing to the upside. Very, very simple price action. Same price reacting massively to the upside. So at this point, you already understand that price is bullish. Now your buyer should be bullish as well. You have to spot your buy opportunity in this particular market. Now looking at price from the 30 minutes time frame, looking at the current price action right here, what we see is that price reacts massively to the upside. Now we initiated that move that broke this structure. You can see this is actually the low. I initiated that massive move that took liquidity above this particular high. Now, looking at this particular point, what happened before price breaks above the high? We have a liquidity sweep, which I said is very, very important. Now, look at what price is doing. This is a liquidity sweep right here. And you can agree with me that this is a slow price action. When we talk about slow price action in the market, this is where institutions were actually building liquidity. This was where price was moving calm. And when price was moving calm at this area, you see a lot of money was resting underneath this low. Money is resting underneath the lows. And after that, you see that buying pressure came into the market in this one candlestick. You can clearly see it. This one candlestick right here pushed to the downside, swept the liquidity underneath the low. You see, it couldn't even close underneath the low. Instead, it spiked underneath this low. Then that is institution making move in the market. Sweeps the liquidity underneath the low. Now we see that massive reaction to the upside. Not just did the price reacted massively to the upside, broke structure to the upside, which is the second rule. Firstly, the first step, you've been able to identify the liquidity sweep. Secondly, you can clearly see that we have the break of this hype. Now, the third step, this is where you look to identify your demand level. So where's your demand level in this case? This is your demand level in this particular case right here. But you can look to refine, and you could maybe look to refine to this candle or this candle. But this is a very good demand level if you're looking to trade from here. Now we have other confluence price left inefficiency at this particular area, and now this has as an engagement area. Very simple trade opportunity which you could approach. Now, what you can do right now is maybe decide to get your entry, place your target. So I think that particular student went for 2%. I've marked that particular guy. He always go for 2% in the market, and it's actually favorable to him since he always go for that. And I said the second area you could look to take your profit is the external range liquidity, which is this particular high we have right here. And if you're going for the high, you're making 3%. Let's press price forward and see how price returns back to this point of interest and how this plays out. Now, price return massively mitigates the level. Now, if you're looking at this particular price action and you have low confidence in approaching it aggressively, this is where you can drop to a lower time frame for your entry confirmation. If you're looking to approach the market with a confirmation entry, let's see the 5 minutes time frame. Now, this is a 5 minutes time frame, and you can see price has returned back to the zone. Now, all you have to do is to read your lower time frame price action and identify where price is going to be shifting in structure. So at this particular point, you see we have the break of structure, right? Price breaks underneath the low, so which means that the lower time frame price action is still bearish. If price take this particular high, this is where you're going to identify the market structure shifts on the lower time frame. But if price reacts, then continues to the downside without actually taking this particular high, then we're going to look to continue with the lower time frame or the flow and not get involved in the market. Remember, if you're approaching this aggressively, then you're active and your trade is running right now, and currently you're in a drawdown. But if you're looking to approach using entry confirmation, have it in mind that you're yet to get involved in this market. Now let's play price forward and see how this reacts. Price continues to the downside. You see, price continues to the downside, spikes again, and it's yet to close underneath this low. So no significant break of structure currently. Price now sweeps the liquidity underneath the low, and now we're seeing good reaction to the upside. So I hope you can clearly see and identify what price did at this particular area. Now, price didn't continue to the downside. The order flow of the lower time frame didn't continue. Instead, what we can clearly see right here is that price sweeps another liquidity right here. So you see this pattern occurs almost every time in the market. Now we're seeing another liquidity sweep pattern on the lower time frame. Price takes liquidity, then moves to the opposite direction, and you see we have the market structure shift at this particular area. Okay, we've identified the step 2 even on the lower time frame. It's tell you that this works on all time frames. See, we have the liquidity sweep, price reverse, break of the high, which is a market structure shift. Now you have to do the step 3 where you look to mark your demand level. So you can maybe decide to mark this level as your demand level. Some actually look to identify their other block. Now we have other confluence, which is going to make this a high probability trading opportunity. We have an inducement area right here. These are inducements at this particular point. Now we equally have some pricing efficiencies right here. So all you have to do if you're approaching this from the lower time frame is placing your entry right there, then place your stop loss underneath the lower time frame zone. If you're actually doing this, you can decide to add few pips underneath your zone. You can decide to add 1, 2, or 3 pips underneath your zone. So this is where you have to place your target. Personally, I do go for 1:4. So if I'm entering this trade, this is where I'm going to take my profits at this particular high. But if you're looking to target the external range liquidity, you're going to see that this trade opportunity presents about 11%. Okay, if you approximate it to this particular high, you're going to make about 11% from this particular trade setup. Now let's see how this reacts. Now we're having the pullback back into the range, and price builds more trendline liquidity at this particular area, which increases the probability of this playing out. And finally, we have an entry at this particular area. See, price comes, mitigates this particular area, which is a very good entry point. See, we have the mitigation at this particular area, and you can clearly see that price is reacting to the upside currently. So I think I have to speed this up a little so price could get to the level, because the truth is it's actually a winning setup because price got to the external range liquidity and is actually reacting even higher currently. So all you have to do if you're looking to trade this with this style is to follow the simple rules, identify your liquidity sweep, identify where price break structure, and this is going to give you very good results. So you can clearly see even on the lower time frame, we have the same price action which have offered good results. And imagine getting an entry from the lower time frame and making 10% in a single trade. This is massive. This is massive trade for me. Okay, let's see the second example. Back to the 30 minutes time frame. I think the second example is going to be the second trade he actually won, which is on NZDJPY. So these are JPY pairs. So let's see NZDJPY right now. So this is NZDJPY. This is the 30 minutes time frame. So we're going to follow the exact same step. If we're looking at this particular price action, I'm going to follow the exact same thing price was doing to understand how he got involved in this particular trade. Now, trying to zoom out, what's the order flow saying? The order flow is bullish. Price is bullish. You see how massive price is reacting to the upside. So any sane trader is not even going to look to sell at this particular point. You're going to look to buy, okay? You're going to be looking for your buying opportunities. Now, let's follow the steps. Firstly, identify liquidity sweep in the market. Now, where did he identify that? This is a liquidity sweep in this market. Price takes the liquidity on the net low, and I already explained why this happens in the market. The institutions are looking to push price higher, but they're going to look to send some traders at the wrong side of the market. See that massive drop to the downside, sweeps the liquidity on the net low. Now they reverse to the upside, aggressively breaking the current structure. This is a very good break of structure at this particular point. Price takes this high. Now we've identified this. What's the next step? Select your demand level, and you see this is your good demand level at this particular area. And while selecting our demand levels, one of the things I use in selecting the area I'm going to trade from is making sure that I have pricing efficiency, and we have it right here. A lot of people is going to ask me, why are you selecting this as your demand level? If you don't understand the fractal nature of the market, then you don't understand why I'm selecting this area as my demand level. Drop into the 15 minutes time frame. On this 15 minutes time frame, you can see that bearish candle, and you can decide to refine to this bearish candle right here. But we're going to stick to the 30 minutes level because it looks better, okay? One thing about the fractal nature of the market is that once you see this kind of wick and you drop to a lower time frame, you're going to see that we have a candle inside that wick. But one thing you have to notice is once you're trading, you have to stick to a specific time frame. Okay, stick to that time frame and don't combine multiple time frame that is out of your trading rules. I've explained a lot of things about time frames, and you need to stick to that. Now, not only identifying that, we have this equal lows, price sweeps the equal lows and react to the upside, but we have a major points of interest at this particular area, and you can clearly decide to enter aggressively, or you still decide to enter with your lower time frame confirmation. But to speed up the class, we're not going to consider entering from the lower time frame. Let's see how this plays out right now. Now price returns back immediately to the range. See how price returns, and you see it taps into the range and reacts massively to the upside. So in this particular case, price didn't even look to come deeper into the range. Instead, it taps and reacts. And if you're actually looking to approach with a lower time frame confirmation, I think you actually got that, because you see, if you drop on the lower time frame, we're going to see the price was bearish. And at this point, we equally have another break of structure right here. I think, see that? Now we have a shift in structure at this particular point. After we had the shift, price came back for the lower time frame mitigation at this particular area. See, we have that lower time frame mitigation. So if you drop to the lower time frame, you're actually going to get an entry. Then you can look to target the external range liquidity. So that particular student usually go for 2% in the market. So he got his 2% around this particular area, and you see how price has reacted, and price was able to take the external range liquidity. And these are current price actions. You can clearly see this is current price action today being 26th of September. So these are good price actions, and you can look to approach the market with this concept. Identify your liquidity sweep, identify where price breaks structure or shifts in structure, and select your points of interest. Very simple strategy. So you can clearly see the two examples. This is the very first one I showed you. This is how he marks that, and you can clearly see he marks where price took liquidity, marked his inducement area, And finally, price returns back to his point of interest and offered him the 2% he was actually looking for. But if he heads to this particular high, he would have made more. But I just love the way he sticks to his rule. You can see we have the second one, which we used as our first example. You see liquidity sweep, break of the high. He identified that. Maybe at this point, he didn't even identify his liquidity area, but I guess he understands that. Now, you see price comes back, mitigates his level, and equally goes for his 2%. And look at how he added few pips underneath his low. So this is another thing you need to learn from him. So just like I said, this is actually a VIP content, okay? Now we have one more example. Let me see that. So this particular one was from a different student, and this one is on gold. So we're going to look at that gold on 5 minutes time frame. So let's identify that right now. So this is the last example on gold. This is the last example on gold. But before that, let me announce our mentorship. Currently, our advanced smart money mentorship is running. The particular platform I was showing you is actually the first batch of the mentorship, which we conducted between January, and the mentorship is actually running. But if you're going to enroll for mentorship, you're going to start the second batch. Okay, you're going to enroll with the second batch, which is currently running. Okay, you can enroll for the second batch, and this mentorship is an advanced smart money mentorship where you're going to learn how to trade with an advanced smart money concepts. Now, in this mentorship, you're going to have access to our course, our advanced smart money course. Going to be part of our weekly chart breakdown. You're going to be part of our support group, which is our VIP. You're going to have access to our trading opportunities. That is our premium possible trading setups. You're going to be part of our weekly Zoom meeting. And this mentorship costs just $216. And after now, it's going to go back to original price, which is about $320, right? Then you want to make payments. These are the payments methods. You can make payments via crypto, or you can make payments via your debit card. So you can look to take advantage of the promo price to enroll for a mentorship. So this mentorship is going to help you find consistency and become profitable in the financial market. So if you're struggling in the financial market, you can look to enroll now. So this is the last example we're going to use for today's lesson. And this is actually on gold, and you can clearly see price is bullish. Price is bullish in this market. Now, what are you going to be looking for? Your buying opportunity. And you see, if you paid attention to the first sketch, which I used for the examples when I started the lesson, you're going to maybe understand this one better. You see, price is bullish now. Institutions moved with large momentum. And at this point, we start seeing slow price action. What was price doing? At first, price takes liquidity underneath the low, not just taking the liquidity underneath this particular low, it was also able to take the liquidity underneath this particular low. And after that, we had the mitigation of this particular level. Price mitigates this level, and we have that reaction to the upside. So I need to pay attention to what price is doing currently. We have the liquidity sweep, which is very, very necessary. Now we've identified that liquidity sweep. Price needs to take this particular high to confirm that you're shifting in structure. Now, we're shifting in internal structure, and we're going to look to identify your demand level. Now, this is your point of interest, which you're going to look to trade from. And you see price left some inefficiency, and here serves as our inducement area. You can clearly see that these are inducement areas. So all you have to do right now is you get your entry right here, stop loss underneath this low, and you can look to place your profit target. A lot of people might look to target the external range liquidity, but I'm not going to advise you to always target that, but have your risk to reward ratio. This is what I'm actually going to advise, okay? Now, playing price for to see how this reacts. See price moves away to the upside and then starts to return, and you see how price comes back, mitigates the level, and we're having that massive reaction to the upside, okay? And I'm very sure that price got to this particular level. Actually, gold is actually reacting to the upside. So you see price move beyond the particular high. Let me play this forward very fast to see where price is currently. You see, after price hit this high, which is external range liquidity, offering about 5%, you see price continues to the upside. And if you're actually holding to where price is currently, you're going to make a lot of money trading with this simple concept. What is this simple concept? Identifying liquidity sweep in the market. You see, this is about 14%, which price has offered based on today's current price action. Let's see the 30 minutes time frame, so this can actually run faster. Based on today's current price action, gold is bullish. Okay, gold is bullish. Yeah, I know I've seen that before. I started recording this lesson, price was actually bullish before I started looking at the market, but although we're having some retracement right now. So if you had that trade opportunities about 20% from this particular level, so this is simply understanding what price is what is doing in the market. This is basic concepts, and these basic concepts is what makes you the most money in the financial market. So all I want you to do right now is to go to your price chart and practice. Just like I always say, practice, practice, and practice. Try to practice what you learn in the financial market. So before you look to start using it, practice and try to master this particular concept. It's going to make you good money in the financial market. So I hope this particular lesson was helpful, and I hope you understood exactly what I explained in this particular lesson. So thanks very much for watching this particular lesson. If you're new to the channel, consider subscribing. You can look to drop a like on this video. I'm Solomon Wisdom, and here is Born to Trade. So thanks once again, and see you in the next lesson.